Welcome to The Deep Dive, where we take your stack of sources and distill the most critical insights, giving you the shortcut to being well-informed.
And today, we're looking at a huge move in the digital ad space.
A really big one. We're analyzing the definitive acquisition and exit from public markets of Integral Ad Science Holding Corporation. You probably know them as IAS.
And this is so much more than just another M&A press release. I mean, this is a strategic retreat from the glare of quarterly scrutiny for one of the key measurement players out there.
Exactly. So we're going to go way beyond headline numbers and really dig into the acceleration of mergers and acquisitions in ad tech, the actual mechanics of this deal, and what this sudden exit means for the competitors left behind.
The ones still in the public markets watching this all unfold. It's a big deal for them, too.
Okay, so let's start with the basics, the core transaction for anyone just catching up.
So too.
IAS agreed to be acquired by affiliates of a private equity firm, Novacap Management, specifically entities called Igloo Group Parent and Merger Sub.
Right, and it's an all-cash deal, which is important. It values IAS at approximately $1.9 billion.
So for the shareholders, what did that look like?
Well, the terms were very clear. They're getting $10.30 per share.
And this was announced on September 24th, 2025. That price, the $10.30, it represented a pretty significant premium, didn't it?
Oh, yeah, a 22% premium over the stock's closing price just the day before, which was $8.46. So it was an immediate healthy bump for anyone holding the stock at that moment.
And the timeline on this is moving fast. The acquisition is expected to wrap up before the end of 2025.
Which effectively takes IAS private. For good.
Yep. And for anyone tracking the stock, NASDAQ has already confirmed it. A trading suspension is coming effective December 24th, 2025, right before the closing. It's coming off the board.
So before we get deeper into the money, we really have to talk about what IAS does, because that's the strategic value that Novacap is buying here.
Absolutely. They're a major global digital ad verification company.
Right. And their service is, well, it's crucial. They provide independent measurement across basically every channel you can think of: desktop, mobile, social, video, and the really big one right now, connected TV, or CTV.
And the heart of their offering is their metric, the Media Rating Council, the MRC accredited quality impressions metric.
And that MRC accreditation, you can't overstate how important that is. It's a huge point of differentiation.
It means it's the gold standard.
Exactly. It means their measurements meet these incredibly stringent third-party industry standards. They're designed to answer the three big trust questions that every single advertiser is obsessed with.
Okay, what are they?
One, was the ad delivered to a real person, not a bot? Two, was it in a brand-safe environment? And three, was it in the right geography?
And they're not just using simple scripts for this. This is where their tech comes in.
Oh, no. We're talking customized, internally developed AI and machine learning. This is what polices that entire digital supply chain.
Which brings us to the sheer scale of their operation. I mean, the data processing numbers are just mind-boggling. As of the end of 2024, they were processing over 280 billion digital interactions.
Wait, per day?
Per day.
That's incredible. You have to stop and think about that number, 280 billion interactions every day. I mean, that's just, it creates this almost unassailable moat of proprietary data that just keeps refining their AI models.
So they've got the tech, they've got the data mode, the MRC gold standard. Let's look at the financials right before this deal, specifically Q3 2025. This is where the story gets really interesting. They were still growing revenue aggressively. Total revenue was up 16% year over year, hitting about $154 million.
Right, so the top line looks strong, but when you look inside, the growth engines were showing some pressure points. Optimization revenue was the star. That was up 21%.
And that reflects a 15% increase in their average CPMs, too.
Yeah, and publisher revenue also grew 21%, mostly thanks to the success of Publica, their CTV ad server. Yeah. But measurement revenue, which is, their bread and butter, that was up a more modest 8%.
But here's the paradox. Revenue is climbing, but profitability was just cratering. Net income for Q3 2025 dropped from $16.1 million the year before all the way down to just $7 million.
And that kind of divergence, strong revenue growth, huge net income drop, that is a massive red flag for public markets, isn't it?
A huge one. So why the sudden steep drop in profit?
That drop is the reason for the exit. That's the whole story. It wasn't a revenue problem, it was strategic spending hitting the books. Operating expenses surged 30% year over year.
30%, wow.
Yeah. It was driven by higher hosting fees, more revenue share to their DSP partners, but the real killer for that quarter's net income was $6.1 million in professional services costs.
And those costs were related specifically to the Novacap merger itself.
Exactly. They were recorded right in G&A. So the company was actively spending money to go private, which lured their profit, while also ramping up the kind of long-term investment that Wall Street just hates to see in the short term.
It really sounds like they were just signaling they were done playing the public market game.
The message couldn't be clearer. To compete in the coming cookieless world, you have to make these massive nonlinear investments in AI that are going to kill your quarterly earnings. Novacap's backing basically says, we'll fund the long-term tech war without punishing you every 90 days for it.
And we should probably mention the elephant in the room here, Vista Equity Partners.
Right. This transaction is their exit. Vista was the former principal shareholder. They guided IAS through its big expansion, and they gave their written consent to approve this merger. So, they got their payout.
And this whole thing isn't happening in a vacuum. It's smack in the middle of a massive accelerating consolidation phase in ad tech. M&A activity jumped 73% in 2024.
And it's moving even faster in 2025. It's a feeding frenzy.
So what are the structural shifts driving all this consolidation?
It really boils down to two things: data and control. The M&A is focused on data activation, connected TV, and retail media. Everyone is racing against the clock.
The clock being Chrome's universal opt-out for third-party cookies.
Which is expected by Q2 2025. So time is running out.
Yeah.
Companies are just buying the tech they need instead of trying to build it from scratch.
Okay, let's talk about the valuation, that 1030 price point. The stock shot up almost 20% on the day the deal was announced. But that final price was actually below the average Wall Street analyst target, which was around $13.
And that's a really crucial detail. It tells you the premium wasn't about getting every last dollar of value. It was about securing certainty.
So they took the sure thing.
It took the sure thing. Market chatter suggested IAS had been looking at options for a while, and prices around $10 had been floated. For Vista, getting a 1030 all-cash exit was better than trying to squeeze out a few more dollars in a volatile market.
And we saw that volatility in the options market, too. The implied volatility for the January 2026 750 put was unusually high.
Yeah. Traders were hedging or betting on big moves, even with the deal price set. And on top of that, analyst sentiment wasn't great. The Zacks consensus estimate had actually dropped from 13 cents a share down to 11 cents just before the announcement.
Okay, so let's pivot back to strategy. You mentioned retail media networks, RMNs. How critical are they to this whole story?
Oh, absolutely critical. RMNs are just eating the market. They are winning over a quarter of all new programmatic ad dollars through 2026. This changes everything.
How so?
Well, the whole supply path is shifting. Programmatic direct is now the most popular method, boosted by RMNs and streaming. And here's a wild stat. Private marketplaces, PMPs, are seeing nearly twice the spend of the open exchange in 2025.
So if all these transactions are happening privately in PMPs, that must connect to this idea of sell-side curation. Can you explain that concept?
Yeah, think of sell-side curation like this. The open exchange is like a massive disorganized grocery store. With curation, the inventory is getting prepackaged and bundled with exclusive data right at the farm, the publisher side.
Before it even gets to the buyer, the DSP?
Exactly, before it even reaches the DSP. So the buyer's losing visibility and control over what they're actually getting.
And that pulls the decision-making power away from them.
Precisely. And this is why a neutral verification tool like what IAS provides becomes even more valuable. It's a check on the system. Novacap knows that verification is critical when the buying process gets less transparent.
So they're buying the key to the verification problem in a market that's becoming more opaque on purpose.
That's a great way to put it. And it's not like IAS was struggling with clients. Far from it.
Right. Their net revenue retention was 111%.
Up from 108 the year prior. And they grew their base of large customers, the ones spending over $200,000 a year to 248. Big advertisers are sticking with them and spending more.
So we have a major independent player going private at the exact moment when independence and measurement are becoming the most critical assets in the game. That is a powerful story.
Okay, and now for our segment. This is not financial advice. This is where we put on our analyst hats and pitch an outrageous but plausible trade idea based on everything we've just discussed.
The stage is set. IAS, a measurement standard bearer, is going private. The market is being rocked by CTC, RMNs, and the cookieless deadline in Q2 2025. So who wins from all this disruption?
Okay, so the trade idea is to initiate a long position in the trade desk ticker, TTD, using far out of the money call options. We're placing a big aggressive bet on the primary public DSP.
Long calls on TTD. That's a bet on maximum upside. Talk us through the rationale. Why them?
Because when a major independent measurement player like IAS leaves the field, it creates instability, but it also sharpens the market's focus on the few scaled public DSPs left standing.
The ones fighting back against that sell-side curation you mentioned?
Exactly. When the independent verification landscape changes, who do buyers trust? They're going to gravitate toward the big, established platforms with proven, non-cookie dependent tech.
Okay, I hear the bull case, but let me play devil's advocate. Isn't there a risk here? IAS was a benchmark for independence. When a key verification company goes private, does that empower a platform like TTD? Or does it actually empower the walled gardens like Google and Meta?
That's a really valid concern, but I think TTD has been incredibly proactive against that exact problem. They're already courting supply with their sellers and publishers marketplace, and they're buying up intellectual property, like their Sincera acquisition, which helps with supply path visibility.
So they're building their own checks and balances.
They are. We're betting that TTD benefits disproportionately because they're seen as the most stable, technologically prepared partner for when Chrome's opt-out finally hits. When this kind of market disruption happens, the biggest platforms with the strongest moats capture the value. And right now, that's TTD.
It's a compelling argument. Bet on the biggest ship in a turbulent ocean to pick up all the passengers. So, to recap the big picture for you, IAS's exit from the public markets is a landmark event in the rapidly consolidating ad tech space.
It really is. The acquisition by Novacap just underscores the immense strategic value of these independent measurement platforms, especially when they're backed by proprietary AI.
And this whole move highlights the accelerated pace of M&A, all driven by the industry's inevitable push into CTV, retail media networks, and first-party data strategies.
And you have to remember, this is a strategic move to reposition for that cookieless future. Novacap's backing lets IAS make those huge long-term investments in AI without the quarterly earnings pressure that was making their books look so alarming.
As always, a critical reminder. The information and the trade idea we discussed are for informational purposes only. We are not investment advisors, and this is not financial advice. You should always consult with a financial professional.
Please do.
But this entire transaction does raise a fascinating question for you to think about as you watch these shifts play out. When a foundational measurement company like IAS moves away from the transparency of the public market, is the goal just innovation? Or does this private transition subtly change the public perception of accountability in the ad supply chain? It's a trade-off that is going to define the next era of ad verification.